Hi traders, welcome to the live webinar with myself, Chris, and Animal Markets. Happy to have you here. We're going to take a look at the live charts and specifically looking for candlestick patterns at critical support or resistance. I think we have plenty of examples today, so let's take a look at that in just a second. First though, be aware that this webinar is shown to a global audience but may not be suitable for everyone. Please visit animalmarketsglobal.com, select your country of residence, and contact the appropriate entity for more details. Also, please note that trading for exchange and global financial markets is considered higher risk. Please seek the advice of an independent financial advisor for more information on that. This webinar is for informational and educational purposes only. By continuing watching this webinar, you agree with this disclaimer and you are aware of the risk involved when trading. All right, sorry, that's for a different webinar in the past. Let's take a look at the calendar. First of all, though, be aware that when trading, it's always important to look at the calendar. You can find that, among others, by going to analytics, animalmarkets.com. First of all, analytics, then going to calendar. And being aware of the events, the numbers that are going to be arising, and because of the fact that they can impact price, of course, and there could be some heavy volatility connected to that. So you got to be aware of that. And next week, of course, one of the big events, political events in this case, is the elections in the UK, for instance. But on Friday we have, if I remember correctly, we have non-farm payroll, for instance. So you're going to have various levels of news events impacting the market. You can also find, when you're there, you might as well take a look at fundamental, technical, and wave analysis, for instance, and the articles, Traders Blog. You'll find a lot of new information there. Actually talked about a two-series articles about technology and how that could impact the economy and the financial market. So that could be maybe interesting. You could check that out, Traders Blog. This Sunday, I'm going to be talking about about how to actually implement your trading plan, not only have it on paper, but actually find useful kind of practical shortcuts that are very simple in a way to implement in day-to-day life, but that lead you effectively to implementing your plan as you want. Not from a helicopter view, but actually from a practical point of view. So that could be something that might spark your interest. So that's on Sunday. Oh yeah, one more thing. Sorry, before we move on. If you are interested in knowing more about the UK election, you can click on this link here. It will bring you to this page, and you'll see some info about that. You'll also see some graphs and stats, for instance, like this, the popularity of the four candidates, the four major candidates. For instance, you'll see some graphs like this, and you'll also see access to our articles and webinars. Alrighty. So yesterday we talked about the fact that price could bounce at this weekly pivot point, and price was making this wick right there. And you can see an example, right, of a candlestick pattern at critical support or resistance. Now this is a 50-minute chart, so it's not a time frame that I was looking to trade. I was looking for the hourly chart, so let's take a look at that. An hour and 4-hour chart, and you see, for instance, here this bearish candle close near the low, decent wick, hitting the pivot point and turning, clear close in reverse. So that is a decent candlestick pattern, I would say. Decent bearish candle at resistance. The resistance confluence being the weekly pivot point and the resistance trend line. So that's a pretty good example right there. We talked about that yesterday on the hourly chart. 4-hour chart, not so much. I don't think that this is convincing as yet. There is a wick here and a wick here. So, you know, those two wicks do provide some information. Looking at the wick here, for instance, comparing it to the body of the candle, you can see that the high and the low, the candle is about 43 pips. The close is about 12 pips away, which basically means that the wick is about 75% of the candle. That is a decent wick. The wick is pretty strong. However, the candle still closed bullish, so that is not a major reversal signal. It is definitely a signal that price is listening to this resistance level of 112. We had a wick before that, so with 2 wicks in a row like that, it is something to at least be careful with or to consider. It is, if it's worth shorting, I would say it depends on from case to case. It could be, it's not a clear-cut rule, I would say. It really depends on the further kind of confluence that you can find and the further analysis. It also depends on what the next candle would be, which is slightly bullish and bearish. So that combination, it's a 50-50 on the 4-hour chart. I don't think it's a great bearish combination. It's not a great bullish combination either. So I don't think it's a great signal here. On the hourly chart, I was looking for a hook back. Remember that is more clear. I think the hourly chart is more clear than the 4-hour chart because you see a good bearish candle. And I was looking for 5 to 6 candles not breaking this high. So it's not a candlestick pattern, it's more a time pattern. This is a candlestick pattern, this is a time pattern. So counting 5 to 6 candles literally would means 1, 2, 3, 4, 5 is a doji, indecision, 6 is bearish. That's it. 6 is bearish. That's a clear-cut indication that price is probably not going to break this high within the next candles. And indeed, it didn't. As you can see, it didn't. So that was not a good time, and I can imagine that some of you are not trading in the middle of the night or at the end of the evening. I talked to a trader through email, and he wrote today, I didn't catch that. I wasn't behind the charts. I can imagine that those things happen, right? This is already, late in the evening, Central European time. So that can happen. But basically, this candle or better even this one, was the trigger, and a short right there with a stop loss above it is doing pretty well. In the meantime, price has progressed and has gone, let's say, our way, and has moved into the direction with moving 20 pips. Not much, but Asian session is slow. However, price now, I think, considering the fact that it's been pretty choppy like this, I'm not sure about the management. I would say even moving it to break even just above these tops does make sense. And it will probably get stopped out for break even, but I'm not sure if keeping the risk on this trade, despite the fact that it's actually starting to look more like a bull flag, is a good idea. I doubt that. So I think taking the risk off the table is a conservative thing, but probably does make the most sense in this case. Yeah. So let's see. There's always a chance to re-enter if it gets rejected here again. If price makes an upside and there's a good 4-hour engulfing twin on the 4-hour chart, there's always a potential to join when that happens. All right, but anyhow, now you see one candlestick pattern right there, interesting, and the idea I also had in mind regarding the time pattern that it will probably make a hook back before it falls. So that's a good example. 4-hour chart, not so good example, but the wick is a significant thing, and if someone would have traded the retracement of that wick, it would have been the same entry as the hourly we just looked at. So it would have been the same thing. All right, so those are a couple of examples. Let's take a look at, let's try to see if we can find some more. Let's see, Esco has a chat about the dollar yen. We're looking at the dollar yen right now, 29 May, 4 o'clock. Yes, that's the one I actually just wanted to talk about today. Let's see, sorry for that delay. I'm just reading the chat. It's always great to, let's see, to get current trades. Esco took a short based on this candle. And that is a great example. That's the one I wanted to point to, indeed. So great job on that. And price hit the S1. That's the next weekly pivot point. So if that target would have been used, which I don't know, but it's about 56 pips from that entry. But Esco has a question. There was a retracement right after that. And so what kind of indicator can be used for the retracement? Well, typically, I'm not, in cases like this, this is such a small retracement. It's only a few pips, 6 pips. So I don't think that's a big deal, to be honest. Oh, it was 20.00. Let's take a look. Or do you mean this candle? Next one. Okay, so let's take a look at the next one. That's a pretty sturdy bearish candle. This one, hi Angel, no problem with being late. We just started. We just looked at a euro-dollar example of a bearish bounce, and now we're looking at the dollar yen, and looking at this candle. Well, one of the disadvantages of this candle is that it's right at the counter, and the target is pretty close by, the S1. So that's a bit of a disadvantage. It is also pretty close to this bottom, so it's not the lower low yet. Maybe compared to these bottoms, perhaps, right? From that point of view, this is a pretty strong candle. I agree with that. But compared to support levels, maybe not ideal. Three levels that are pretty close by. So from that point of view, maybe not the best from that point of view. It did continue, hit the target, and then bounced, and then hit resistance and made a move down again. So ultimately, still still worked out fine, I guess, if you entered here and somehow managed the trade, but you didn't have much space. Let's see how much it moved, about 33 pips. Now it's going sideways between support and resistance. These are standard weekly pivot points, by the way, for those that are wondering. So to me, from a wave perspective, this is the final fifth wave. If you look at this, this is 1, 2, 3, 4, 5. So the fifth wave as well is not something that typically, is known for large movements. So I would use support levels and wave counts to, to kind of not be so excited about this particular candle, and skip this one. Yes, you do have that pattern, 3 bearish candles in a row, which is called the big soldier down. I'm not good in these names, but that is indeed a pattern, a candlestick pattern, but it occurs pretty late in a way compared to the support level. I like this one more personally because it is indicating a resistance rejection at the level, good bearish close, a wick right there. So that I like personally more. It's within the retracement still, so you have momentum, retracement, and that's the first signal, and therefore you have more space down to the support level. So it's basically reward to risk ratio, support levels, and wave counts that make me think that this is a better candle than this one. Yeah, definitely, if you want to use weekly pivot points, it's good for swing trading. It's good for even long-term trading. So if you use scalping, for instance, it's better to use daily pivot points. I mean, you could still have weekly pivot points on the chart if you want to know where those key levels are, just in case. That's fine. You can use both. But if you're swing trading, I don't think, inter-week trading, inter-month trading, you don't necessarily need daily pivot points. If you're intraday trading, scalping, then daily pivot points is very useful. This pivot point is Admiral Markets pivot point, and I don't have really preference. I think both are very good. I don't necessarily need to use both because then it really gets a bit crowded. I think I could add them right now. Then it made his own, or actually has his own. It was made by someone else actually, but has his own Camarilla indicator. And that's how it looks like. So you see H5 with R2, H4 with R1. So there's some confluence, but this is weekly pivot point and weekly Camarilla plus, let's see, weekly and monthly. You see there are two Camarilla levels on it. That's pretty cool. That's the new Camarilla indicator that Nanet is using now. But to be honest, I think one of the two is fine. I don't think necessarily both is needed. All right, so let's see. Back to this example. So those are some of the reasons I personally would not be that excited about this one. If yes, I would look for a retracement. Because of those factors, I would say, okay, I want this price to get back to about halfway the candle so that there's a little bit more space and balance between the risk and the potential reward. All right, pound USD, we spoke about that one yesterday too. That depends on this candle. If it closes above the weekly pivot point, you know, that could be a breakout, or if there's a bearish candlestick pattern, that could actually be a bounce or break spot. Remember, so it did close bearish. We closed just a few minutes before this candle, I think, if I remember correctly. We do see some good wicks before that already. That helps. Then we see a massive wick plus bearish candle after that, which is a double confirmation from my point of view. That's a great candlestick pattern right there for downside. We got a good momentum up. This is a pin bar from my point of view, and indeed leading to a good downside after that. So that was a great example of a bearish candlestick pattern at weekly pivot point resistance and moving average and Keltner for a bounce to the downside. So anyone who traded that, I think, got some good pips out of that. If you're still in that trade, probably moving it to this high right there, just above that top, makes the most sense at this moment. And perhaps it could continue. Price might break through this support trend line and continue. So that's something that could occur today or tomorrow. And if not, then pretty good to reduce the risk and lock in some profit right there. So that's an example of a good bounce. Yesterday we talked about that one live. Also the 4-hour candle, if you thought that, you know, if 1-hour candle perhaps was too risky, 1-hour chart, sorry, then the 4-hour would have confirmed that. Good candle at the pivot point and a little bit of retracement of that candle and then a further downside. So these are the examples we spoke about live pre-fact, in fact, and you can see them afterwards, how those candles arrived. I talked about how the candle should look like often, and this is a good example. And you see, you know, the trade develop nicely. That doesn't have to be always like that, of course, but in this case, I like that fact for a bounce right here because of the fact that this is, among other things, strong resistance, sorry, and that this could be a wave 4 within a wave 3, good momentum here. So a break of this low, I thought it was pretty decent probability. And we have the fibs as well. Another resistance confluence. The settings for the weekly pivot points. Let's take a look. Weekly one, as you see. This is what I have now at this moment. Those are just colors. So that's about it, I guess. No, I don't have an indicator for that, for missed pivots. I'm not even sure what you mean with that, actually. What do you mean with missed pivots? I'm not sure I even heard of that term. I can't recall it at this moment, at least. Maybe if you explain more details about it, I would get a bit more idea what you mean. So let's see. Any other examples? We could take a look at Aussie. We were talking about yesterday too, I think. Anyhow, at this moment, this looks like an engulfing twin, just a little bit above the weekly pivot point. Which doesn't make it really ideal from that point of view. But the pattern is pretty strong. It is a pretty good candlestick pattern. So if there's any doubt, you can always look at lower time frames, of course, and see if there's more information that can be found for a turn. So if the 4-hour chart shows a reversal pattern potentially, we can look at lower time frames and see if there's any weakness here, right, for instance, or here, and there's any signals of a turn, then that's a good way to squeeze in a potential short that capitalizes on a higher time frame. So rather than taking it all the way down here, if there is a retracement possible and there is a rejection here, you can squeeze in kind of a smaller short and maximize the reward to risk with less risk in a way, because you have more confirmation of a turn on the lower time frame here. Of course, sometimes that could be a false signal. It could be upside, retracement, and then upside. That's always the risk, of course, involved with using lower time frames. Maybe ideally it could be the 30-minute or hourly chart, because the 50-minute could give a false signal like that. ASCO is, by the way, looking to enter your dollar for a buy. I think that I can see your point. I think that personally it's still bearish kind of structure, but I wouldn't be surprised to see a bullish break to the upside. I mean, that would not shock me either. So I can see your point. For me personally, it's still within just before resistance. So I would rather wait for price to have a good 4-hour candle break above it and then look for a retracement for more upside, or look for still a rejection here for potential downside. But I see your point. There is some momentum here. The wicks are there, but not a convincing 4-hour bearish candlestick pattern. Plus, if you look at the hourly, this is looking choppy, which therefore looks more like this. So those things are there, indeed. And all in all, this is looking choppy too compared to this. So this could be a bull flag, and that makes a lot of sense that that break could happen. So I can see your point. No one knows what will happen, in fact, and that's always like that. That's part of trading, and that's good to actually, be aware for our own bias. Sometimes we get a strong opinion and we think that something must happen, but absolutely not. Totally agree with you, Hubert. Nothing has to happen and no one knows what will happen. But at certain spots, we do have more probability. This one is like a 50-50. I really think that it's equally possible. Certain areas, I do think that upside or downside is very likely. Like, for instance, here we had a strong momentum, and after this retracement, for instance, the chance of continuation is very likely, right? So here we have a skewed favor side. But even then, you got to be aware that it's good to have confirmation and validation levels. Know that when the analysis when price is confirming what we think or invalidating. So we got to be on kind of flexible for that and not kind of remain in a fixed thinking mode that the price must follow our actions, our thoughts, our plan. We got to trade what we see, not what we think, basically, indeed. And often we keep trading what we think instead of what we're seeing. So although I was bearish, I do see a bull flag, right? So that's something I got to keep in mind. Therefore, I'm open to a breakout to the upside. That's one way of me trying to be flexible in a way, because if it were up to me, I would let this thing fly down if I could choose. But because I saw a lot of resistance here, and the turn did happen, right? Slowly but surely. But it's going really slow. So I'm open to my initial analysis being invalidated. That's part of the process of adjusting one's analysis. I was bearish. The bearishness did happen. I just deleted my euro dollar. The bearishness did happen, but it's not as strong as I would like it. Let's say it's not confirming exactly the bearish development that I was thinking it would. This bullish reversal right here, you mean? This candle? Start of London. Let's see. Yes, it's very true. This move is very powerful indeed. And that's also one thing that this momentum could lead to this breakout. But the thing is, especially the pound dollar, but any currency pair, any currency pair in fact, this could be a bull flag, but it could also be the start of a downtrend. This could be wave 1, 2. This could be wave 1, 2. And this could fly down for wave 3. Doesn't seem that likely maybe now. I think it's still 50-50. But I would even agree if you would say this is less likely than perhaps a bullish reversal. But in any case, it is possible. Just because you have momentum here doesn't necessarily mean, because we are in a downtrend, we got lower lows and lower highs at this moment, doesn't necessarily mean it could be an impulsive correction. So that is not the only thing that we have to take into account. It is a signal. It's something to be aware of. And if it therefore we get a good 4-hour candle like this, it would confirm this momentum, and I think we got a good breakout going on. But this alone is not enough for me because of the fact that it's in downtrend, and I've seen this before. This could still be a reversal structure. And yeah, enough about waves. I don't want to bore you with waves, but even if you're not an Elliott waver, if you don't label waves, it's still good to know about the general idea, I think, so that you don't have to label it, but instinctively, you know, you could already think about various options, right? This is an ABC, or this is a 1-2, 1-2, without necessarily labeling it, actually labeling it. Someone mentioned gold, so let's take a look at that right now. I'll get to the next question, Hubert, very soon. I just want to look at one chart first. Let's see gold first. Let's take a look. Right at the weekly pivot point. It would normally be a bouncing spot, obviously. There is divergence, though, between these tops. And it's in the middle of a channel. Personally, I don't think it's a great spot. Considering the 4-hour divergence, I would only look for bounces at S1, at the trend line, and at the long-term moving average confluence. That's where a bounce could happen. And even then, I think that price will actually retrace deeper before moving up. But that's my wave bias. So let's forget that for a moment. Let's only look at support and resistance and candlestick patterns. From that point of view, I think that this confluence is stronger. It could bounce here. Who knows, right? As we just explained. But I don't think it's interesting to trade because of, I just don't expect a strong bounce here. And I think that the potential to move up is also limited. plus the divergence pattern. So when you have divergence on a 4-hour chart like that, the main target is the long-term moving average. So that kind of filters out potential trade here, in my opinion. Now, of course, we don't have to use, for support or resistance, we don't only have to use Admiral pivot point indicator. We can also use others. I have the Keltner on the chart. That's another way of trading it. Actually, we spoke about that a couple of weeks ago already, about using, for instance, the candlestick indicator and using price to get back in the Keltner after it broke out of the Keltner. Maybe one of these could be a setup for a bounce, for instance. We spoke about that 2 weeks ago. So if you're interested in that, you can find it on YouTube, Adam Markets YouTube channel. You can look at that. But even, of course, the Keltner is not something you have to use. You can use Bollinger Bands. I like Keltner personally, or you can use Murray Math, Fibs. There are a lot of things we can use for support and resistance. Supply and demand. Let's take a look. Even moving averages. Ichimoku, parabolic. So there's a ton of choice. Commodity channel index. Wait, that's a bottom indicator. Sorry. So yeah, there's a lot of choice from that point of view. But today we're looking more at pivot points. So sometimes the weekly pivots like this, for instance, you have a bounce at S2, but the candle itself already closes the entire gap up to S1 because the weekly pivot points are pretty close to each other. So in this case, if you're using weekly pivot points, right, it is not an easy situation because you kind of squeeze in between support and resistance. I think it depends on the larger context. We see support here and resistance here, so it's making kind of a larger sideways move. From that point of view, we're at the bottom. So there's a supply-demand zone here. So from that perspective, there's probably a good chance that price will continue and push through the S1. S1 is, of course, not necessarily, it is a resistance level because, opposites occur. Broken support becomes resistance, but it's not the original intent of an S1. The original intent is a support that has been broken. So it's something to be careful of if price is approaching the S1 from the opposite side, right? From below instead of from above as a resistance. But I think it's a fair assumption still to take a trade like that if the overall analysis is favorable to take a long right there. Or you can dive into an hourly chart, see how that world looks like, see maybe if there's a better entry possible. For instance, maybe upon the retracement here, if you put a fib on that candle, for instance, it's a pretty good strong breakout candle, and you see a retracement to the 38.50 fib zone right there, then that could help with the reward to risk, because if the supply demand zone is the target, if we have an entry here and we put the stop loss below the candle low or the bottom, and the target is in the supply demand zone, even those few pips really help with the reward to risk ratio. And this was a pretty strong zone because of the fact that you had good momentum before it and good momentum behind it and a pretty flat area. And you see that price indeed used that. And it doesn't have to be weekly pivot points, of course. Engulfing twins at the supply and demand zone could be an exit. I mean, the best exit would be somewhere in here, obviously. But if you have doubts, you could take the exit here and even potentially take a short. That's not going anywhere at this moment. The price is going sideways though. So the engulfing twin was pretty good. However, the fact that so many candles have occurred after that without going anywhere, from my perspective, I think that it's time to move the stop loss at break even. From a 4-hour perspective, this is 1, 2, 3, 4, fifth candle is bullish. I would exit I would expect that I would not expect this price to continue necessarily. It could, but I wouldn't count on it. So I would, reduce the risk by moving it to break even, basically. All right, because what could happen is, let me explain. This is a sideways range. We had momentum here. We had momentum here, some momentum here. So we're seeing some momentum up and down. 5 candles not breaking this low is indicating a bounce at S2, at the support, and is indicating that this momentum is probably over. And we don't know what the next swing will be, but it's not, I don't want to count on this necessarily. So the rejection here could have made sense, but is taking too long. The bounce here made sense and has hit profit already. So that's some examples on the euro yen. Euro AUD is pretty rangy, so not much examples there. Maybe it's a good time to take a look at other pair. Do you have any particular in mind? Oh, Esco is talking about the pound USD. We can take a look at that again. The parameters of the moving average, by the way, just a quick answer is basically a couple of ways, actually. The long-term moving average indicates a major support or resistance level. Sorry, I should say it differently, a major bounce or break spot. A major trend decision spot, I should say. Because if price is above 144, I consider it uptrend. If it's below 144, I consider it a long-term downtrend, right? Although if it's breaking for the first time, you still got to be careful, right? So the whole area is basically a decision zone. So in this case, price was above it, so it's either a break or bounce spot, right? Break or bounce spot. So in both cases, it decided to continue. So it's a major trend decision zone. Here it was down, it decided to cross and go into uptrend. So that's one thing. The 144 EMA I use as a major trend decision spot. The 21, and it's a divergence target. So if there's divergence, the main target, give or take, is the 144 EMA. So two things, the trend decision, divergence target. The angle is not important in my opinion. Second is the 21 EMA band I use. I don't show it here because it gets too cluttered, but I do use it for my personal trading. High, low, close. You can take away the close and only use the high and the low. Yeah, 144 EMA. The high and the low indicate support or resistance band. So what will happen is basically the band would be like this. So it's going to give smaller retracements like this. And I use it for continuation bounces. All right, sometimes, of course, eventually it's going to break through that band and retrace deeper. And then I use an 8 EMA or something called an HMA, and that's for really quick momentum. That's for gauging if price is really in a strong momentum, or is it in a trend, but it's kind of like, slowly moving. So it will really hover like this around it, and this break will indicate, okay, the momentum is kind of has faded. It could still be a downtrend, right? Because price is still below the long term, and it's probably actually still within the 21 band, but it broke above the 8 EMA and it broke above the HMA. I like the HMA, so the momentum is out of the focus. So I use one for momentum, one for short-term trend, and one from long-term trend. Short-term trend is also, the 21 EMA is also for support or resistance. Yes, it's a 144 EMA close indeed. Oh, gold, just quickly back to gold, very, very quickly, sorry for that. 1 hour chart, double top. I didn't see it myself. Maybe, but I would need a fractal here. I would need two candles not to break this high. And in that case, I would agree. All right, let's see. Esco is saying that I'm not sure which diagonal support line, but that's okay. Normally price will go back to retest the pivot point, which it did indeed, or will continue down to S1. Oh, from here. From here, I would expect price to break and continue. And if it doesn't, I wouldn't want to be in that trade necessarily. But it's still possible. It could still retrace, make one more attempt, and then fall. But I think the better option if it right away falls, definitely, from a time perspective. And the fall could be substantial. I would agree. I think that 127 is the minimum target. I would expect, but it could fall further. I'm not sure about 121. That's pretty far. I mean, it's possible all the way down here, but that could take some time before that happens. So it depends on your patience. Depends what type of trader you are. There's nothing wrong with that, but it's just you got to be realistic and say that's not going to happen today. That's all. I think that I honestly don't know how the election will fit in because I just look at waves, I look at technicals. I don't think too much about how fundamentals will impact price. I think looking at the structure looks bearish. However, one thing I do want to stress is that before the elections, there will probably be some volatility, but sideways volatility, I would expect, because of the uncertainty. There could also be some retracement and squaring up. So if the pound dollar falls a lot, there are going to be some profit taking of the shorts because of the uncertainty, and price could actually make some corrective volatility retracement like that. So, or if price goes up a lot, it will make some slight correction down, but then eventually go into a range until until there's more clarity about the decision has been made during the elections by the voters, and then the market will choose maybe some direction or not, right? So it's very difficult to tie in news like that. Yes, they do. Big news does interfere with my entries. In theory, too, with my predictions, because sometimes they could invalidate my analysis. Could totally blow them out, let's say. That's why I have invalidation and confirmation levels. That certainly happens. Sometimes the news event totally confirms it. So that depends. It does interfere with my entries because I am not a big news trader, or not at all. So I don't like taking entries just before NFP or during NFP. So I mostly sit on the sidelines personally. So maybe a bit boring. I know that a lot of people actually like trading it because of the market movements. But I rather actually like slower but more, let's say, gradual movements, trending movements, than massive ups and downs, or let's say, uh, price action that is just reacting to the news event. I rather have more technical trading. Yeah, definitely less stressful indeed. For me, definitely. So that everyone's different, but the elections are still a week ahead, so there's going to be plenty of trading still. The elections are going to weigh in a bit. Don't get me wrong. It's something to be careful of, but I think it's still some good time in front of us still before it has a bigger impact. It is looking like it's going to break, and considering the fact that this could be a wave 4 and a wave 5 of a wave 3, I think it could still have some more downside left. All right, so yeah, that's about it, I guess. No currency pairs mentioned so far. So we can take a quick look. I don't see any examples either. So that could be it then for today. Let's take a look very quickly at the upcoming webinars. You can see here, June 1st, that's tomorrow. We're taking a look at that election, by the way, how to trade the, or approach it and trade it. And then next week, Friday, a special webinar, unplanned, or I should say not unplanned, but an extra webinar. Typically we have, of course, Thursday webinars. This will be a Friday after the election. Results are probably known by then. We're going to take a look at the impact of that result on the markets and on maybe the political environment as well quickly. So that's coming up. You can check that out right here at the event page from the UK elections. Right there, you can find it at the top of avonmarkets.com browser, or you can sign up through Education, Forex, and CFD webinars as well. And you can see them right there. Next month, we got new webinars, new topics coming up. So we got a bunch of webinars here. You can see June 7 and June 6, entry and exit tactics on Tuesday, candlestick and Fibonacci patterns at support and resistance on Wednesday. There's going to be a series of, I think, 8 webinars again. So that's, very simple. You just sign up to one of them and you sign up to all, I think, 8 or 9 even. So that makes it simple. So hope to see you in those webinars, and wish you all great trading, folks. Cheers.